So thank you very much for joining us today. I'll start off with a little bit of introduction about who we are, and then we'll kind of get into the session a little bit. You know, full disclaimer, neither of us are originators, neither of us are funders. So why are we here? We represent Deloitte Corporate Finance. We have the building. Great. And Deloitte Corporate Finance is, everybody knows Deloitte for audit, tax, consulting, but Deloitte Corporate Finance, for all intents and purposes, is the investment banking platform of Deloitte. And we essentially do two things. One is M&A advisory, where we actively sell companies on behalf of business owners and the like. And the other is we have a capital advisory practice, where the bulk of what we do in that practice is actually raise capital for mid-market companies. A lot of what we do in that practice is actually working with specialty finance firms. And we are very active, whether it be consumer lenders, whether it be B2B lenders, subprime auto, you name it, we probably. They're not connected yet. Have we been? Oh, they are connected. Oh wow, that's not. So as I was saying, a lot of what we do is working with specialty finance firms, whether it be consumer lenders, business-to-business lenders, subprime auto. We probably have touched it all. It's been a practice that we've been growing for the last few years. And raised loan book capital for companies, subordinated debt, and even at times run mandates for equity as well. It's a growing practice. They're very proud to be a member of the specialty finance community in Canada, and look forward to increasing our exposure to the community. So that commercial aside,
actually we're not done yet. So the only thing I'd add is to give people context. We would find ourselves running and closing about 6 to 9 deals in the specialty finance area every year. So you put that all together over the last 3 years, we would have done about $2.5 billion of capital. This is primarily loan book funding. And deal sizes would range between 25 million to 250 million, give or take. One was over $1 billion, which we're keeping that one in the 2.5 billion. The count looks good. But other than that, it's very mid-market in nature. And clients would range from somebody who's been at it for 2 to 3 years as an originator to somebody who's got decades of vintage behind the business.
Great. So the format of this session is really meant to be audience-driven at the end of the day. We really want to hear from you, and we're happy to answer questions that you pose to us. I know many of you are originators, many of you are funders, and so we're happy to give you our tips, learnings of the trade, if you will, as we've ran a lot of processes in this space, and give you an insight as far as where we've seen best practices and where we see things fall off the rails a little bit. We've seen all the horror stories, and we've seen the best success stories as well. So that's really the goal of today. Nobody likes to be first, and we don't want to have any dead air time, so I can kick things off by asking Romit a question. And really it's geared towards, at the end of the day, a burning question for many originators is, when is the right time to arrange institutional capital? It's a timing question, it's also a business life cycle question. But having ran these processes a lot, Romit, why don't you give us a little bit of idea from your insight of when would be the right time for a company to seek institutional capital?
Yeah. So the way we think about it is, as I said, we're seeing it soup to nuts, right, in the evolution at the time, the timing at which we get involved. So at the end of the day, it's what we've learned over the years. It comes down to 3 fundamental things that you gotta be ready enough on as an originator to go to the institutional market. It's 3 legs of the stool, as I call it. So number 1, there's sufficient credit performance that's been exhibited that you can point back to. And I saw one of the funders in the crowd immediately nod, because that's the number 1 thing that thank you, Roger, that a funder would look at. So that's kind of critical. Second would be some demonstration of having achieved critical mass scale in the loan book, but more importantly, now that you've gone to the institutional market, line of sight into deploying that new form of capital, right? So if you're out there, you build a small loan book of a 10 to 12, $15 million, and you're seeking the next $50 million funding facility, the funder wants to know that those funds will get deployed in a very reasonable amount of time, right? So that's kind of the scale question. And number three, perhaps the most difficult one to solve for, particularly the earlier stage companies, would be line of sight to equity. The toughest piece of the capital stack to arrange, as some of you would nod and admit to the pain, is the equity piece of the capital stack, right? Particularly for the earlier stage originators. Once you evolve to a certain level, there's a big universe out there of more mature private equity firms that are strictly focused on specialty finance companies only, but there's quite a threshold before you get to that point, before that tap opens up. So just to kind of recap, that was a long answer, but 3 legs of the stool. There's credit performance. You can point back to the data on your vintage curves, on your collection curves. Second is scale, and number 3 is path and line of sight with sufficient equity going down the line.
That's great. Why don't we open it up to the audience if there's any questions from any of the originators or any of the funders in the room?
Try not to make it too awkward for us to sit here without any questions, so.
Otherwise, I'll start calling on people. I think we have a question.
I think for U.S.-based investors, how do they look at Canadian companies, say, the same or differently than they look at the same companies in the U.S.?
Are you thinking debt or equity, both? That doesn't matter?
Debt.
Debt, okay. Very timely question. So the amount of liquidity in the U.S. funding market is unprecedented right now, right? As I was in Dallas at a conference that we host every year only 2 weeks ago, and we took 20 companies, Canadian companies there, 6 of which were specialty finance companies. And it's a speed dating event where relevant private equity firms would come and meet with those companies. We were frankly a bit fearful that the specialty finance companies may not get enough reception from the private equity community. Each one of them had over 15 meetings in the day, right? And that's when an equity group kind of reinforced, more than one equity group reinforced, that every week there are 2 new credit funds still being announced in New York and Boston and Florida. So the liquidity is unprecedented still. I would say, and you'd hear more of this on the afternoon panel, I hope, from one of our US funder partner who would be on the panel, but the US funders are increasingly present in the Canadian market. They are very on top of the trends in the Canadian market, and they're not going anywhere else, right? The one thing I'd say is that they've come to understand as a cautionary point is originators haven't delivered on scalability of the business, Canadian businesses, as much as maybe the funders were promised out of the gate, right? So getting big facilities, which with promises of deploying $100 million of capital over the next 18 months, has proven a bit more difficult than planned. So scalability, like anything else Canadian, we're a big country but with a small population, right? So scalability remains an issue. But those would be the key things that come to the top of my mind. James, you had a question?
Yeah, I think being a U.S. investor, I think that's all very fair. I guess the question I have is, you guys are sitting kind of, not the brand new startup sort of companies that are able to get to a certain level that gives you certain scale that come to you and you can raise capital to get to the next level. What asset classes or types of lenders are you looking at currently for, the bigger parts of the market that you see growth in?
Yeah, so we're doing work across all asset classes firstly, but there are trends on what's hot and what's not, right? So anything, it's a multifaceted equation, but I think in Canada, because we trail the US on the evolution of any market and the size, we're 3, 4, 5 years behind every sub-asset class that you can think of, right? So what does that mean? That means many of them haven't matured in Canada, or they haven't cracked out, right? In other words, an example would be subprime auto, which you only have to put a couple of calls into funds out in New York to learn that it's turned out of favor, right, in the US. And it's been that way for, James, you'd say 6, 12 months, thereabouts. So, and James, every time we talk to him, would remind us that, Wells has pulled out of that market, right? So, no, I'm not increasing the advance rate and I'm not reducing the pricing, right? So the point is, that issue of certain asset classes getting overextended in the US market hasn't really come down to Canada yet. And knowing the inherent conservatism built into the Canadian economy, we don't see it overextending itself as much as some of them have in the year. But to kind of answer your question more directly, we're doing work across secured consumer, which would be home equipment loans, which tends to be highly desirable for a whole lot of different funders because it's secured. Borrowers are homeowners. To subprime model being the other end of the spectrum, or actually other end of the spectrum would be unsecured, high coupon credits to subprime consumers. On the small business side, I think that's another example of where scalability has been a bigger issue in Canada, wherein the whole investment thesis was the banks are great, but they're great at coming down up to a certain level in terms of their borrower size in small business. So there's a huge untapped market. Hasn't really performed that way, wherein there are several operators, they've built nice businesses, but they're starting to run into some scalability challenges. Boy, I can talk a lot.
Lila.
Yeah. How about the evolution of the specialty funds in raising debt capital from, let's say, the debt funds more towards banks? And I know Canadian banks are not big partners here, but let's say the US banks. What's tipping the scale from like a debt fund towards a conventional bank fund?
I don't know if you want to take any of these.
Yeah, sure, I can take it. In our opinion, what we've seen really comes down to a lot of what Romit said at the beginning about the time to go for capital. That timing question comes into play in every point of the company's life cycle. As they gain more track record, as they gain more scale, oftentimes the pool of capital providers actually open up for them. Generally speaking, there's a rule that we follow. There is a funder for every stage of the company's life cycle. Early stage companies that may not have as much track record, there's a funder usually for them. Sometimes it comes at the cost of capital, sometimes it comes at the cost of advance rate. But those things tend to get better over time as the company gains traction, knows what they're doing, understand how they go about their credit adjudication and collections processes, how they use data, the whole bit. And then the other aspect is purely based on scale. The US banks start to get very interested on transactions, we have found, where there is a larger ask. And if they see a scalability question with the company in the sense that this is a bigger ask, we can put more dollars to work, we can wrap our heads around it a little bit better. Generally speaking, though, they're still laggards. I would say even the U.S. banks are still laggards in the industry versus some of the specialty credit funds. But we have recently gone to mandate with a larger ask, and we found the U.S. banks to be quite active in the space. But then again, you're dealing with a company that has decades of experience. You're dealing with a company that is larger and has a lot of data to back up what they're doing. I would say generally it comes down to the company life cycle more than anything else. And how often have they gone to market for institutional funding?
I just quickly add that, yes, they've been laggards. They've been participating in the specialty finance market on a very selective basis, more in a strategic capacity wherein there have been some partnerships struck on, with the companies that had their logos displayed on the screen. I think several of them have been handpicked to strike one-off partnerships with. But we think of the Canadian banks, they're increasingly getting comfortable with being a participant. They're nowhere close to being aggressive. They're not going to win the bids if we take these opportunities to market. So likely not. But where they're playing nicely is, we think of Canadian banks as on the less esoteric asset classes with little to no reputational risk. They are a very good, low cost, but low advance rate funding provider, wherein then somebody like us has to marry them up with a more aggressive credit fund who would take that advance rate from the 50-60% to the 90% range. right? So a sub-debt provider. So it's not a one-stop solution for anything funky. It's something in the middle, then the historic boring stuff and the new funky.
Other questions in the audience?
Oh my God, we talked about this, Sean. Go ahead.
You didn't like my question. Maybe talk a little bit about the advantages of working with an advisor to source capital versus perhaps try to solve for your capital provision on your own.
High advantages. Strong. But
Is there another option?
but there's a longer answer. So look, two fundamental reasons to engage an advisor. One, the deal gets done, and second, there's no money left on the table. Right? And our job is we're end of the day we're investment bankers at our depth of our hearts. We're not going to take deals on that don't get done just to cut to the chase. Like you and Sean, and so that's a bit of a filter right up front. When you work with a firm like ours who's taking 6, 9, 10 deals to market a year, James, you will testify to that, you get a bit of a volume discount, for the lack of a better phrase. So you get immediate credibility as an originator working with an advisor, and by running the old cliche, the competitive process, the ability to make sure that the client has met the objectives, not just found the capital, met the objectives, lowest cost, highest advance rate, whatever the optimal mix was. But again, very strong advantages to the short answer.
I think James cringed when you said volume discount.
Cringed at discount to start with.
I mean, just to pick up on that a little bit, a lot of what we do at the end of the day is we're matchmakers, in terms of the seekers of capital with the providers of capital, figuring out the right fit. But a lot of what we do is actually crafting the story and helping out in framing the picture of what the company actually looks like. And some of these stories are not exactly easy. In a situation where a company may not have 2 cycles of credit on their book, and it may not show all the track record that funders ideally would like to have, really it involves us kind of diving deep into the analytics and crafting the story on management and crafting the story that they're able to achieve the scale that what they would like to do. So that's the help of an advisor, to be able to craft a story, pound the pavement, find the right funder for the company that we're looking for.
I know we're trying to get you to raise your hands, but just reflecting on one of the questions earlier about a combination of your question and James's, what asset classes are being keenly looked at in Canada by particularly US funders. So I'm not sure how much of the alternative mortgage market is represented in the room today, but that's an interesting space because there's been all this noise and some paranoia that the music's going to stop at some point in the mortgage market. But on the flip side, the B20 phasing in of that and just the confusion caused by it, what that has done, to state the obvious, is it has led to greater opportunity and origination volumes for alternative mortgage lenders. And it's not lost on the smart US funders that it could be a very unique opportunity to play at the right risk-reward equation in what is a fundamentally conservative housing market in Canada, right? So we've been approached, and we are smart enough to quickly flip that on its head to start prospecting similar companies, getting engagements, and then taking certain alternative mortgage funding deals to the US market. A bit of an educational process at the beginning to tell them what's going on in Canada, given the B20. Once they kind of wrap their heads around that, it is, end of the day, a very uniquely timed and attractive situation, wherein you can, for the same credit that was getting funded at, pick a number, 5.95%, 12, 18 months ago, an alternative funder is stepping in and funding it at 8.99 because of some circular sent by an authority, right? So it is a very unique time to be doing that.
Yes.
Go ahead, please.
You mentioned 50-60% advance rate from Canadian banks. What are you seeing from US funders? on advance rate and cost of funds?
So the comment about 50-60% advance rate from Canadian banks, I mean, that was just said in more, I think, in passing, that the banks, when the Canadian banks are getting involved in specialty finance, we find them to be more of a strategic situation, and they may be very conservative on the advance rate, but it's bank funding, so it's attractive from a cost of capital perspective. From the U.S. banks, from the U.S. institutions, and let's even throw in other funders within Canada, like the Life Co's and the like, Roger being here, we're finding that they have the ability to go much higher in terms of advance rate, and it really depends on again the asset class, as well as looking at the loss and collection curves and understanding the nature of the business. So for near prime type of businesses, you can push the advance rate well into the 85-90% range, and at times even higher. But when you get into subprime type of categories, subprime auto, for example, it'll be tough to get higher than the 80-85% range. But you have situations where you can get into the high advance rate level, depending on the asset class more than anything else.
I have a different answer, which I often do working with you, but it is a convoluted equation, right? And there are some fundamental models by which funders come up with the advance rate answer, right? And from an originator's point of view, there is no free lunch. So if you're seeking a super high advance rate, in which case, for a secured asset, say home equipment loans, furnaces and the like, of course you can go north of 100%. Right? We all kind of know that. But it comes at the price of liquidity, i.e. cash reserves set aside, which you're funding by way of either equity or borrowing from the same funder to set money aside and then paying interest on that money, right? So the advance rate answer is dependent on what are you solving for and where you are in the evolution of your own business. If you're equity strapped, right, then of course you're going to seek the highest advance rate, and if your product in that situation supports a gross yield that can pay the high coupon that comes with the high advance rate facility, sure, that's the best you can get at the time. But if you've gone to the next level where equity is not a problem, right, and your secured asset, the underlying receivable, can attract a significantly high advance rate, it's going to come at the cost of setting aside equity, you'll choose that. But that's a long answer to kind of say you need us to figure it out, and to flush out the best deal on the market. But also the range out there is very aggressive, right? Other than deep subprime, highly esoteric asset classes, you can think the short answer is in the 90s, right? And it can be north of that.
Those are all very good points. We always encourage our clients when they think about advance rate to think about it from the entire capital stack perspective, because there is a cost to equity at the end of the day. So you can get a very conservative advance rate at a very low cost of capital, but it's going to come at the expense of putting up that equity, and you should put a cost associated to that.
So follow up.
10 years forward, are you guys seeing any differences in covenants, lightening the covenants from the U.S. funders?
Yeah, so things have been loosening for a while. Pricing's been going down, covenants are getting lighter, funders are being made to compete more for the business. I think your broader implied question is, are there clouds on the horizon? Because funders start to tighten up when either they're seeing risk or there's not enough supply for them to be bending over backwards to win the deal. So nobody's got a crystal ball, but mine says we're still 12 to 24 months out before any tightening of the music.
So Gary is giving us the good old cutoff thing, but why don't we just open it up to the audience for one more question if there was anything burning. Yes?
What's hot? So there's lots of B20 mortgages to go around, obviously. Have there been any deals done on that other than with mix or mortgage funds with, let's say, non-traditional credit providers there? And
follow-up to that is, if not B20 mortgages, what are people looking for now?
It's a tough question to answer because there are only so many types of, so many names in each subsector in Canada. So if I start calling them out, you kind of know who they are. But given the high amount of liquidity out there, the funkier, newer to Canada asset classes like litigation financing, right, as an example, is now an asset class that has proven that it's fundable like a classic, non-prime auto type of asset class, right? So is that hot? It's hot for me because that opens up a new subsector to go and chase and do the next 5 deals in. But what's really hot in terms of volume is the what's boring at the same time, right? So it's secured either by way of getting a lien on the house, or, and I'm not talking mortgages, I'm talking other stuff that gets plumbed into the house, and as a result is able to create a lien for the lender, or it's basically point of sale financing, right? And the beauty of point of sale financing is the scalability of it. We're all consumers here, buying stuff. I'm buying more and more online. If you can plug in your platform into being a provider of that point of sale, scalability, one of the 3 legs of the stool is taken care of. So that is hot for that reason.
If I could just quickly add to that, anything that's heavy data driven, we're finding hot. So the more that companies and industries are using data to get smart about their processes and scale and collections, we're finding those are hotter markets to be in.
And that's a really good segue to end because we got a hot data panel up our next round.
Hot is the word.
And I think it's great. And this is a good thing. Once you get started talking, you want to stay talk forever, right? And but everybody's still available, long tail of the event, and we'll keep the dialogue going. So thank you so much.
Well, thank you.
Thanks for the question.